Hey everyone, I'm Trevor with Premise Mortgage, owner of a boutique mortgage brokerage here in the state of Massachusetts. And every day I'm asked, when are interest rates coming down? Well, I'll be the first to tell you I cannot predict interest rates. And anybody who says they can, you need to go the other way immediately. What I can tell you is where I feel interest rates are headed based on current economic conditions and what recent events have taken place. I'm going to break that down for you. So, what we all hear about every day in the news is the war conflict in Iran, right? Since that has started, oil prices have risen significantly. And as we know, oil is tied almost to every aspect of our life. It is in everything that we do and consume. It is in transportation, it is in manufacturing, it is in agriculture. So when oil gets more expensive, everything else gets more expensive. That's inflationary. Okay, now what no one is talking about is the recent shift in monetary policy by the Fed back in mid-December. See, the Fed recently shifted from QT to QE, quantitative easing. They started buying $40 billion a month in short-term treasuries from banks, which reduces their short-term interest rates, which essentially increase their liquidity. Well, with that increased liquidity, banks started making more loans at these lower interest rates. Okay, so what that is essentially a creation of money. It's an increase in the supply of money. Now, we can measure this by what's called ODL, other deposit liabilities. See, historically, ODL has maintained an average between 3 and 3.5% over the last 10 years. But during that period of time from mid-December to mid-April, ODL averaged 9%. During that same period of time, economic growth was somewhere between 2 and 2.5%. And what is persistent inflation? The supply of money outpacing economic growth. So we had ODL growing at 9% versus economic growth going somewhere between 2 and 2.5%. That is inflationary. So it's essentially like the double whammy. We have the rise in oil prices here and also flooding the economy with money. Now, when you bring these two together, it is a likelihood that the new Fed chair, Kevin Warsh, is going to have to actually increase rates in the near term rather than reduce rates. Because both of these, with these two things combined, the likelihood that inflation persists and actually goes up is stronger than it is coming down. And that has been shown with the two recent inflation reports, PPI and CPI, which is wholesale inflation and producer inflation, has shown last week that inflation has risen way higher than expected. And with no progress being made in ending the conflict or war in Iran, oil prices are going to continue to stay elevated. Additionally, there has been so much damage caused by the oil and gas infrastructure that it could take years and millions, maybe even billions of dollars to get us back to before the war started. So it's not like if the war just ended tomorrow that all of a sudden we're going to go back to normal. No, this is going to take time. And time, if it takes an extended period of time, and with the demand globally for oil, it's just basic supply and demand. We have too much of a demand and not enough supply, and that's going to continue to elevate prices. So when we have the continued elevation of prices, plus with this quantitative easing of the Fed, yes, they have reduced their QE from 40 billion to 20 billion a month, but even at that new mark, ODL is going to be somewhere between 6 and 7%, which is much higher than the 2 to 2.5% growth economically. So we're flooding the economy with money at the same time that oil is bringing up inflation because everything is getting more expensive. Well, what this means is that interest rates are most likely going to rise and not come back down. So if you're a homeowner trying to time the market, don't do it. No one ever hits timing the market. I shouldn't say no one ever. Yeah, people get lucky, right? Just like when we go to the casino, you get lucky gambling. But gambling is not a strategy, okay? Not at all. So if you're a homeowner, know this. And right now, the best way to look at it is look at your monthly cost, look at all your monthly obligations, right? And if you can afford it, then now is the good time to buy, not later. Because as we know, that homes are only going to get more expensive, especially here in the state of Massachusetts with inventory being low, right? Prices are going to maintain, they're going to continue to be elevated, okay? And as you know, property taxes, homeowners insurance, those things continue to rise. So if you wait, most likely interest rates are going up and the cost of owning a home is going to go up. So the right strategy is to price effectively now. Take a strong look at your finances, your monthly obligations, and if you can maintain that monthly mortgage, the time is now. I hope this all is a good piece of information for you all, and look for me on the next video.